All right. Good morning, everyone. Welcome into the day 2 of our mortgage market research conference. I'm now very pleased to introduce to you Bob Hunt, our Senior Vice President at the Federal Reserve Bank of Philadelphia. Well, not sure if you know, among the 12 reserve banks in the Federal Reserve System, well, we share some common expertise in areas like macro, banking, and community development. In addition to that, each of the reserve bank has its specialty and emphasis. For New York, it's securities. For San Francisco, it's probably international finance. But for Philadelphia, it's consumer finance. And Bob is the head of our Consumer Finance Institute. Well, without further ado, let me turn it over to Bob.
Thank you, Sean. What he was really saying is we have really great people here, and I get to take credit for it. And for that, I have a lot of gratitude. I am Bob Hunt. I'm the Associate Director of the Consumer Finance Institute here at the Philadelphia Fed. On behalf of the organizing committee, which includes Sean, Renelle Lewell, Lori Lambie Hansen, and James Vickery, I want to welcome you to the second day of this Mortgage Markets Research Conference. And I want to take a second to thank all of the fantastic people that make an event like this work. And so that includes Christian Santiago, Josh Rivera, Karen Kleski, and Charisse Verdi of our meeting services team. It includes Barb Brinko for our editorial services, Monica Conrad for graphics, and Sarah Messina for our social media. And I especially want to thank the one and only Nicole Rizzo, who keeps the whole machine running like a fine timepiece. I want to invoke the standard disclaimer for all of our Federal Reserve System guests today. Our remarks today are solely our own and not those of our respective employers of the Federal Reserve System. So yesterday, we had several presentations on the lessons that we learned from the COVID-19 pandemic, as well as an overview of the data resources and techniques that are available to us today. In the second day of this conference, we're going to feature 8 research papers that build on those resources to examine important policy questions, including the following: climate change, the design of mortgage contracts and the secondary markets that emerge from them, who gets access to mortgage credit and why, the role that heterogeneous financial contracts, such as adjustable rate mortgages, and the asset positions of consumers, for example, the home ownership rate, plays in the transmission and distributional consequences of monetary policy. And finally, how the regulation of leverage for prudential purposes spills over into the labor market. Bob Avery alluded to some history yesterday. He mentioned a conference we held at the bank in 2009 that was the genesis of the National Mortgage Database. I believe that was the second conference that I had organized when I took over the predecessor to Consumer Finance Institute. Now, the idea behind that database had existed before, but that conference set the stage for making it happen at that point in time, and that is the power of convenings just like this. That's why I think it's very important we do what we do. However you feel about the responsiveness of financial supervising research community during this pandemic, compared to the previous financial crisis, I would say that we were far better informed, which enabled us to make recommendations that we put into action far more rapidly than a decade before. And that's because we built up a foundation of data and analysis that was vastly superior to where we were in 2006. The pandemic itself spurred new investments in data and the exploitation of new computing and statistical techniques that were actionable at the time that policymakers needed it. Larry Cordell's opening remarks yesterday underscores. I'm very proud of the role of the Philadelphia Bank, Radar, and the Consumer Finance Institute that we have played in this story. It's an honor that we've been able to make some modest contributions for the greater. With that, I'll turn it back to Sean.
Well, the other day I was joking with someone saying it's probably not easier to get into this conference than getting into AER. Well, It was a joke, but there's probably some truth in it. We received well over 120 submissions. We could only take 8 papers, so we had to reject a lot of great papers. But today, we have 8 great papers, which we organized them into 4 sessions, all right? Our first session will be on climate change and the mortgage market. Well, before we get started, let me just remind you some ground rules. So in terms of time allocation, we will give each presenter 25 minutes, and then each discussant 12 minutes. That will leave us 8 minutes for Q&A. And then just to remind everyone to please use mic at desk if you want to ask a question or make a comment. Okay? If you have your laptop on and connected to Zoom, please do mute both the speaker and the mic on your laptop, right? Okay, so with that, let me invite the very first presenter, Sastry from MIT.
So thank you for including me as part of the conference program, and I'm really looking forward to your questions and the discussion by Amine. This is my job market paper, Who Bears Flood Risk? Evidence from Mortgage Markets in Florida. So in terms of motivations, the key question that's motivating my paper concerns the fact that flood risk is increasing over time due to climate change. And in terms of which asset classes are most exposed to this risk, we know that housing and mortgage markets in particular bear large exposures to floods. Over the last decade, the housing markets have experienced over $500 billion in damages, and by some estimates, over $1 trillion of coastal real estate is exposed to sea level rise and hurricanes. So an open question for us as researchers is, who bears this risk in residential mortgage markets? So in my job market paper, I look at how flood risk is allocated across 3 agents. First, the households that live in flood zones. Second, the lenders that originate mortgages in these areas. And third, the government, which provides flood insurance contracts. A key feature of this setting is that not all mortgages can be fully insured against flood risk. The reason for that is these government flood insurance contracts only insure up to $250,000 in flood damages. This means that large homes in flood zones that exceed that coverage limit are underinsured against flood risk. So the question for me is, who bears that residual uninsurable risk? Is it the household or is it the bank? So why does it matter? I argue that tracing out these exposures matters for 2 reasons. First, there's a financial stability imperative to understand whether large risks are being mispriced by mortgage markets. I have a quote here from Fed Governor Laurel Brainerd where she says, "It is vitally important to strengthen the U.S. financial system to meet the challenge of climate change." The second reason this matters comes from a moral hazard and efficiency standpoint. We know that when insurance is subsidized, that leads to overdevelopment and overmigration into high-risk areas. You can imagine that a similar mispricing of risk by mortgage contracts could have similar effects, leading to an inefficient allocation of people to risky areas. So what I do in my job market paper is I first produce a novel data set where I merge digitized flood maps with loan-level mortgage information, which allows me to obtain loan-level classifications of flood risk. And then I focus my empirical analysis on obtaining the effect of flood risk on mortgage terms. I look specifically on 3 key mortgage outcomes. I look at loan-to-value ratios, I look at the mortgage's interest rate, and I look at the mortgage's subsequent performance in terms of delinquency. Here, delinquency is going to be defined as whether the mortgage is more than 90 days delinquent within 3 years of origination. I'm going to look at 3 different sources of variation in flood risk. So first, I'm going to look very simply at mortgages in and out of flood zones. This is a purely descriptive exercise that aims to understand how mortgages differ on average for borrowers that live in flood zones. I'll then use 2 empirical approaches to try to obtain the causal effect of flood risk on mortgage terms. The first will exploit those strict flood insurance coverage limits that I mentioned earlier, and the second will exploit the release of updated flood maps that change the boundaries of flood zones and lead to changing risk assessments by lenders. Using these three sources of variation, I obtain three key findings. First, I find, perhaps unsurprisingly, that banks offload flood risk to the government through flood insurance contracts. The second finding is that for borrowers that cannot be completely insured against flood risk, the way banks manage that is they actually require lower loan-to-value ratios from those underinsured borrowers, or equivalently, they require higher down payments at origination. I find no effects on interest rates and other terms of the contract. Finally, I find that this rationing of credit through higher required down payments has real effects, and it shifts the composition of mortgage borrowers towards richer and higher credit quality people that are less liquidity constrained and can afford to pay higher down payments and flood insurance. So in terms of my data, I bring to bear 10 data sets that I categorize as follows. So first, I have information about the mortgage contract. This includes the mortgage's interest rate, loan-to-value ratio, maturity, securitization status, and subsequent performance. For this, I combine data from Black Knight McDash and the Home Mortgage Disclosure Act. My second data set, the second key feature of my data set is that I have individual borrower level characteristic. So in particular, I have the borrower's FICO credit score, and I have the borrower's income at origination. That comes from McDash and from Hamda. I also have information about the characteristics of the house. This includes the property value at the time of the mortgage origination, the size of the building, the address, and information about local construction. And I'll explain in a couple slides why I need that information on construction costs. Lastly, I have information about flood risk. So this includes the current flood zone of the mortgage, as well as this includes current flood maps as well as historical flood maps, which allows me to obtain the flood zone classification of the mortgage at the time it was originated. I also have the effective dates of these flood maps. I have information on flood events and damages, and information on flood insurance take-up, which I got from FEMA through a Freedom of Information Act. So after combining these data sets, my final sample covers the state of Florida. I focus on purchase mortgages for single-family homes, and my time period spans 2010 to 2016. So the first thing I do, now that I've constructed this data set, is produce some preliminary descriptive facts to show what characterizes mortgages in and out of flood zones. So in the first panel, I have run a regression where I regress loan-to-value ratios on a dummy variable for whether or not that mortgage is in a flood zone. And you can see in the blue bar that on average, mortgage LTVs are about 280 basis points lower in flood zones. When I control for zip code year fixed effects, that coefficient declines slightly to about 180 basis points, but it's still statistically significant, telling us that some of this variation in LTVs is driven by zip code, but not all of it is. When I control for borrower characteristics, so here that's going to be the borrower's income, credit score, and the property value of the house, that coefficient shrinks further to a little bit less than 1%. And when I include the full set of controls and fixed effects, I find that on average, loan-to-value ratios in flood zones are 85 basis points lower than out of flood zones, holding constant the borrower's income, credit score, property value, and looking within zip code. When I do the same exercise for interest rates, we can see here that on average, there's no significant difference in interest rates in and out of flood zones. And when I indeed control for the full, for the zip code year fixed effects and the borrower control, we see that on average, interest rates are about 1 basis point higher. This tells us that really the action is in LTVs, not in interest rates. And then finally, when I look at delinquency, I see that on average, when I don't have any controls at all, delinquencies are in fact lower in flood zones. But when I include the full set of controls, we see that in fact delinquency is no higher or lower in flood zones. In fact, it's quite a precise 0. So there's sort of two key takeaways from these descriptive facts. The first is that lenders bear less exposure to housing collateral in flood zones, and that lending in flood zones is not observably riskier than lending outside of flood zones. So what the descriptive facts don't tell us, though, is why LTVs are lower in flood zones. And there are really two competing stories that could explain the same set of facts. The first is a credit supply story, which is that banks are managing their exposure to flood risk by requiring higher down payments. The second is a credit demand story, which is that flood zones have unobserved amenities that attract borrowers who then prefer to pay higher down payments, and that it really has nothing to do with sort of risk management at all, and it's just a happy accident. So to try to tease apart the demand and the supply stories, I use two identification strategies. So the first identification strategy exploits these flood insurance coverage limits. So the government flood insurance provider is FEMA, and they have a 95% market share in this market, and there's very limited private insurance available. There's very limited private insurance available above that coverage limit for households that live in flood zones. That's the most precise statement. And so what I do is I exploit this coverage limit using a cross-sectional difference in differences design, and I'll explain that in a bit more detail in the next slide. And the goal of this strategy is to address the endogeneity of unobserved wealth. The second strategy I'm going to use is these remappings of flood zones. So every 5 to 10 years, FEMA comes in and creates a new flood map and redraws the boundaries of flood zones. And the idea of this strategy is I'm going to exploit these remappings and use a staggered differences in differences design, where I look at the same area before and after a remapping, and I see what happens to mortgage terms. And this strategy allows me to also address unobserved amenities, but allows me to look at real effects because I get to see what happens to the composition of borrowers after the remappings. So now I'll describe the first strategy, which is a cross-sectional difference in differences design. So let's consider 4 borrowers, A, B, C, and D, and their LTV ratios. So A and B both live in a flood zone. A buys a $100,000 house, so A can be fully insured, and B buys a $300,000 house, so B is underinsured. So what happens if I compare the LTV ratios of A and B? Well, I'm going to obtain the causal effect of 2 things. I'm going to obtain the fact that B is probably wealthier than A, and so has different preferences for mortgage terms. But I'm also going to estimate the effect of the fact that B is underinsured and A isn't. So comparing A and B is not going to be very helpful at identifying the causal effect of interest. So the way I'm going to deal with that is I'm going to think of 2 additional borrowers, C and D, who live outside of a flood zone. C also buys a $100,000 house, and D buys a $300,000 house as well. So why did the LTV ratios between C and D differ? Well, here it's likely due to the fact that D is wealthier than C and has different preferences. The idea here is that because both of these borrowers are outside of flood zones, we're not going to be obtaining the effect of flood risk. So the cross-sectional difference in differences estimate will give us the causal effect of flood risk under the following identifying assumptions. The first is a parallel trends assumption, where I assume that the wealth difference between A and B is the same as the wealth difference between C and D. In other words, there's no differential sorting of people into flood zones by wealth. The second is that the effect of wealth on LTVs is the same in and out of flood zones. So in terms of identifying whether this identifying assumption holds, what I've done here is I've plotted average incomes by replacement costs for homes in and out of flood zones. We don't have data on wealth, that's sort of the key variable of interest, but we do have data on income. And what we can see here is that in fact these 2 lines are parallel, which support the identifying assumption I mentioned earlier. And so what I do is I'm now regressing LTVs on a dummy variable for whether or not the mortgage is in a flood zone, a dummy variable for the replacement cost, and an interaction term for replacement costs in flood zones. And what we see here is that there's no LTV reduction for homes in flood zones when those borrowers can be fully insured. But the minute that you cross that $250,000 threshold and the house becomes underinsured, you start to see an LTV reduction. And furthermore, that LTV reduction is increasing in how much of the house is underinsured, which is exactly what we would expect if banks are worried about the fact that they're lending to someone who's going to be underinsured and they have to manage that risk. When I do the same exercise for interest rates, we see that interest rates are slightly higher, but not significantly so. So again, this confirms the earlier descriptive facts, saying that really the action here is in LTVs. And then finally, when I look at delinquencies, we don't see a statistically significant difference, although the estimate is quite noisy because the base level of delinquencies is already. Sorry, so the takeaway here is that if you buy my parallel trends assumption, what we have here is that banks are requiring higher down payments from borrowers to manage their exposure to uninsurable flood risk, and that there's no adjustment of LTVs when those houses can be completely insured. Now, in my second identification strategy, I exploit the fact that every so often, FEMA comes in and draws new flood maps. So the idea here is that different counties receive updated maps in different years, and some areas receive new maps that expand the boundaries, and some areas receive maps that don't change the boundaries or even contract flood zone boundaries. The control group here is going to be areas that are not remapped at all or not yet remapped, because this is a staggered difference in differences design. And the intuition here is I'm going to look at the same area before and after the updated map. So I'm going to be very specific about how I implement the staggered difference in differences design. So here I have Orange County, which is a hypothetical county in Florida. I have 4 zip codes in Orange County, A, B, C, and D. So these are the flood zones under the old map. And now there's a new map that comes in, and the flood zones for A and B expand, but the flood zones for C and D stay the same. So it's not obvious what should happen to lender expectations in C and D because the flood zones didn't really change. But we would expect that in A and B, banks would think that lending there is riskier because now the flood zones have expanded. So what I'm going to do is I'm going to focus on zip codes A and B where the flood zones expand, and I'm going to look at C and D in a robustness check later. So that's the first way of defining treatment. The second step of defining treatment is that there are counties that are not yet treated. So Green County here gets remapped after Orange County. So Green County is a not yet treated county. And then finally, there's Blue County, which never gets remapped in my sample at all. That's also a control county. So the mortgages in my sample will include the mortgages from zip codes A and B, the mortgages from zip codes E and F in green, and all the mortgages in my control county blue. And I'm going to use this notation C of Z to denote the fact that for a given county, I only include the relevant zip code. So when I do this staggered diff and diff, I find that loan to value ratios decline by about 2 percentage points 2 years after the remappings, and about 2.2 percentage points within 3 years after the remapping. When I do the same exercise for interest rates, again, we see that on average interest rates do increase, but it's not statistically significant. So this is saying that after a new map comes out and the boundaries change, banks update their assessments of risk and they react by requiring higher down payments. When you look at the composition of borrowers, what you see is the average income of borrowers increases by almost 10 percentage points in the years following the remappings, and credit scores increased by almost 5 points. So now this is telling us that the flood zones expand, down payment requirements increase, flood insurance requirements are implemented. So the only people who can afford a mortgage now are people who are richer and have higher credit scores than before. So this is changing the selection of borrowers who can afford to live in these high-risk areas. Other outcomes don't actually change very much with the remappings. So we see that DTIs are virtually the same and that the average maturity doesn't change as well. So again, the key margin of adjustment here is LTV. And as you would expect, when LTVs decline, delinquency rates also go down. Although again, it's only significant at the 10% level. So now the key question is, I sort of find that LTVs are adjusting, but the question is sort of, are they adjusting enough? So do lenders still retain exposure to flood risk after adjusting LTVs by 1%? My answer is going to be that it is an effective adjustment. No, they do not still bear flood risk. And the way I'm going to do this is I'm going to do a back of the envelope calculation that compares how much delinquencies are reduced from the lower LTVs to the expected delinquency increase due to floods. Now, I'm not going to sort of, this is not the hill I want to die on. This is the back of the envelope. I would ideally have more information to do this calculation, but this is sort of a first pass at getting this estimate. So what is the delinquency increase that we would expect due to floods? So that's roughly going to be the same as the probability of uninsured losses over the life of the mortgage. Or that's the way I'm going to get at it anyway. So what is that number? So if you live in a flood zone, you have about a 1% annual probability of having a flood. That estimate comes from FEMA data, where the probability of a claim in a flood zone per year is about 1. And I have data in the paper which shows that about 10% of floods cause damages that exceed the $250,000 threshold. And then finally, the average mortgage duration in my sample is about 5 years. So we take that together, and the probability of uninsured losses over the life of the mortgage is about 50 basis points. From the remapping event study, I show that a 1 percentage point LTV reduction reduces delinquencies by about 50 basis points. This is because I show that on average, there's a 2 percentage point LTV reduction and delinquencies reduced by about 1%. So if that ratio is the same, then we would expect a 1 percentage point LTV reduction to reduce delinquencies by about 1%. This requires a lot of assumptions. One of the key assumptions here is that lender recovery and delinquency is going to be the same in and out of flood zones. I don't have data on recovery rates. That would be sort of a better way of getting at this. But instead I use delinquency. So this tells us that the LTV adjustment is about right. So to conclude, I find that lenders are effectively offloading flood risk to the government and to the households, and that they're not actually retaining this risk on their own balance sheets. I'm also finding that this tighter credit is changing the composition of flood zones. There are sort of 2 policy implications here, which I used to motivate the talk at the beginning. First, there are implications for how we design our flood insurance program. The key beneficiaries of flood insurance are those mortgage borrowers that can be fully insured and do not get credit rationed. We know that there are a large portion of borrowers who are wealthier who do get credit rationed, but maybe that's okay. But what's important here is that the flood insurance program provides about $1.3 trillion in coverage annually. We talk a lot about sort of implicit insurance being provided by the GSEs, but here we have an extraordinarily large explicit insurance program provided by the government and by taxpayers. And to provide some comparison, in 2017, the government guaranteed about $5 trillion in Fannie, Freddie, MBS. So this is not a trivial program. The second policy implication concerns systemic risk. So my results suggest that the combination of flood insurance and lower loan-to-value ratios does a reasonably good job of protecting the banking system, and that banks are adapting to new information about flood risk that's coming in these updated maps. I also argue that this lender rationing is helping to dampen the taxpayers' overall exposure to flood risk by leading to this advantageous selection of richer people living in high-risk areas. However, there are also limitations here. The data set I use is McDash, which covers mostly the traditional banking system. So there could be important differences in these dynamics for independent mortgage companies that are less represented in the McDash data. So thank you so much. I think that might be my time. So I'll stop here and I guess, yeah, thank you.
Our discussant, Amine, Ouazad from HEC Montreal.
Thank you very much, Parinitha, for a great paper, a great presentation, and so my comments will be much more about the landscape and the sort of set of players in the mortgage industry. So I'm in Montreal until August, and I'll be at Rutgers Business School after that, and so looking forward to working more on mortgage and risk, climate change. So it's a fantastic paper. You've digitized flood insurance maps since 1996, if I'm correct. This is incredible. There's this quote in the paper saying, I obtained archive FEMA flood maps from geospatial libraries at Princeton, University of Texas, University of Florida, Harvard, Berkeley, during a pandemic. And that's kind of a big achievement, I think. And so that's kind of the holy grail, and that's amazing. And I think it's also much cleaner identification using a spatial difference in difference rather than using cross-sectional RD designs
I mean, I think if you've tried RD designs using the National Flood Hazard Layer, you've realized how difficult it is to do because there's the SFHAs are very thin, so it's getting observations there is kind of difficult. So a key insight. I'm realizing I put that on the slide. You said you wouldn't die on the hill on this hill, but I thought it was actually a fantastic, important insight. Just do lenders still bear flood risk after reducing LTVs by 1 percentage point? And you say no, the delinquency. The decline in the delinquency from the lower LTV is approximately the increase in delinquency due to floods. And so I'll just leave that equation here. I think it's really what I will remember from the paper. So who bears flood risk? So I just wanted to take sort of the main question of the paper and try to write the list of different players in the mortgage industry that may be bearing flood risk. And I think you're absolutely right to focus on the central relationship, which is between lenders and borrowers. And you have in mind the option model of strategic default, which is that as floods reduce the value of the homes, that reduces their equity and that increases the probability of delinquency. So there's a sort of a very large literature on strategic default. And I apologize if the slide is not comprehensive. With 2 citations there, I don't pay tribute to the immense amount of work on strategic default, including those on those work on the financial crisis. What's interesting also, and maybe you want to emphasize this, is that this is a paper about lenders' behavior and not about borrowers' behavior, because when borrowers expect greater default, they should take on more debt, consistent with this paper in RFS by Hertzberg et al. In 2018. There are other ways of thinking about the LTV choice than the option model of strategic default. One of them is using the Rothschild and Stiglitz approach of signaling the type of the borrower. That's been formalized by Jan Bruckner in a paper in 2000. And so there's a question about the self-selection of borrower type into flood zones. In I think an earlier version of your talk, there was a slide showing that it was higher income households that were in flood zones. So I think it's really important to sort of emphasize that you're working with the option model of strategic default, and i.e. the moral hazard part, and not so much with the adverse selection story adverse selection story. So who bears flood risk? There are many other players in the industry, and I think what makes the research in this field fascinating but also really tricky is to really isolate who's bearing flood risk. One of those is maybe too obvious, is sellers. There is an incidence of the flood insurance mandate on house prices. And so I was wondering whether a lower house price in flood insurance zones could lead to a lower LTV. So there's a caveat that back in Sen and Barrage showed that households underestimate flood risk and that prices don't fully reflect flood risk. The agencies, Fannie Mae and Freddie Mac, there is a literature dating back to 1996 about adverse selection and mortgage securitization. But I think here the story is subtle, and I'll try to provide some thoughts on this. Holders of private label mortgage-backed securities, and these are 2 citations, are not about climate risk, but about the PLS market in general. It would be interesting to see, because the PLS market is different from the agency mortgage-backed security market in the sense that defaults are passed through in the PLS market. I think there's an important distinction here. The PMI market, and I think there's not enough literature on the PMI market, and I think there is a discontinuity at the 80% LTV for PMI requirements that may play a role in the story here. The NFIP, so this famous paper by Gallagher and Hartley, 2017, on the fact that flood insurance payments after Katrina led to reductions in debt. It's really interesting that a lot has changed since Katrina. The CBO did an analysis of the balance of the NFIP and showed that the NFIP was in the red. So maybe that's sort of evidence that these guarantees may be costing something for taxpayers. Caroline Kowski has also a paper where she shows the decline in the take-up of NFIP policies, both in number and dollar amounts. So I think, and Caroline Kowski also shows a large increase in defaults outside NFIP flood zones. So probably we need to sort of think about pre-Katrina and then post-Katrina separately. And also the industry includes servicers. So there's a trading of mortgage servicing rights. It's a little known corner that may also bear flood risk. So LTVs and agency securitization. You have a figure in your paper, figure 3, which is, I think, really key that I'll display here. So LTVs and agency securitization. Here it's a little tricky because the way I understand it is that the main way in which the LTV affects the cost of agency securitization is through the G fees. So I've put here on the slide the loan level performance adjustment matrix of G fees. So in the rows, we have the FICO score of the borrowers, and in the columns, we've got the LTV range. So you can see that for those borrowers that are deemed the most creditworthy according to their FICO score and the LTV, the G fee is 0, but then it goes all the way to 375 basis points. Now, this LLPA matrix is really important. Over the weekend, I just pulled MacDash and I sort of drew the bunching in LTVs at each threshold of the LLPA matrix. One of the things you see is that there's a sort of a bunching of LTVs for each of those columns of the G fees. That shows that probably lenders care about those G fees. So figure 3 shows that your results hold are significant when focusing on loans that are sold to the private labor market, are held on the balance sheet, and I think this is really a key result there. PLS market, so we want to think about the fact that defaults affect PLS cash flows. Those of you who've worked with PLS pools also have seen that there's sometimes very few mortgages in PLS pools. So maybe the diversification is not full there. So originate and hold. So who is originating those mortgages that are held on the balance sheet and for whom the LTV responds to flood risk? It's mostly banks regulated by the Federal Reserve System that have liquidity. So these are 2 graphs that that are from our recent paper. There should be a discontinuity at 80% LTV also because the PMI requirement kicks in at 80%. On the PMI, I think we would need more data on the PMI coverage because the minimum coverage requirement of the PMI is 6% for LTVs between 80 and 85%. So 6% is a small amount. Okay, so the next point is about the incidence on house prices. The fact that if house prices are declining in flood zones, this is a little bit like a tax, right? And so in Econ 101, every one of us has taught that this is borne both by the buyer and by the seller. And so if the cash on hand used for the down payment stays the same, we should expect the LTV to go down and the down payment to increase in relative terms. So I was wondering whether this is a story of the incidence of flood risk onto house prices. Finally, I wanted to make a little bit of a hydrological point on the paper. The digitization of FEMA flood maps is wonderful. It's fantastic. One of the sort of the key questions that has tortured me for the last 2 years is how to separate hydrological risk from FEMA flood maps. And so, here what I've put is a diagram from the technical manual of the U.S. Army Corps of Engineers. And somehow, for some reason, the U.S. Army Corps and FEMA should speak more because there are changes, for instance, in land cover. More parking lots means a different flood risk. So perhaps what you could do is take the National Land Cover Database It has updates every 5 years. I think we have one in 96, if I'm correct. And this is the hydrological, it's part of the hydrological cycle, and shows you the fact that changes in land use will affect discharge, and discharge is an input in the flow routing models. And so I want to give a practical example of this is I took the National Flood Hazard Layer of 2017 and I mapped areas protected by levees. That's the code X for those that are in the weeds of that literature. It's in green here. And what you have here is a city called Foster City in California in the San Francisco Bay Area, whose levee system got lost accreditation by FEMA. And so you have here a change in the flood map that is also linked to a change in the both in the risk and in the flood insurance requirements. So how do we tease those two out? We probably need something else. You have the First Street Foundation data. That's one way to look at it. And I'm sure in the next 5 years, there's going to be so much more hydrological data available, apart from the FEMA flood maps, which are discontinuous and binary. Thank you very much. Yeah, and it's really outstanding work. I really look forward to the next version of the paper. I look forward to a new friend on climate and mortgage finance, and could discontinuities and bunching be useful in your paper? Thank you very much.
All right, thank you so much, Amine. I'm impressed by the chart you put together on LTV and GP. It's always great to have someone like you who can pull the data and then add a chart or a regression to the discussion, right? Now, let's get into the Q&A section of it. I guess I should probably invite, Perry to come up here. So let's maybe first take a question from the audience here. Anyone? Andy?
Yeah, did you look at the delinquencies during flooding events in those places, or just sort of the overall delinquencies? And also, did you take into account foreclosures? I mean, sorry, forbearance, which is sort of now common during those events.
So my paper doesn't exactly focus on sort of what happens after a flood, but I have separately looked at flooding events and the effects on delinquencies. And you do see an increase in delinquencies following large hurricanes. And yeah, I guess I haven't looked specifically at the effect of forbearance versus not, but I agree that that's a very important part of the story. Yeah. Future work.
All right, thanks. Maybe we should take a question from Zoom. Now, let's see. Charles Capone I think he has several questions. Charles, go ahead, please.
Yes, thank you. I'm here on Zoom. Can you hear me?
Yep.
Yes.
Great. I think my question has to do with the big storms that you just mentioned, because we know when there's a major storm, the effects go outside the flood zones. And you seem to have a binary classification of inside and outside of flood zones. And just wonder if you thought about nuancing that in terms of even adding areas adjacent to flood zones as kind of a second tier area where you can actually have uninsured property damage. So as you noted, when there is insured property damage, the lender is, for the most part in the clear. But if it's uninsured property damage, they're not in the clear, right?
Great. Yeah. So I have definitely thought a lot about this. Kind of as background, Hurricane Harvey, for example, 40% of people affected by that were outside of government flood zones. So the accuracy of the flood maps, or maybe the inaccuracy, is something I've thought a lot about. So what I did in my job market paper is there's sort of two parts of the paper. The first part, where I look at insurability, is within zip code, looking in and out of flood zones. But the second part, where I look at the remappings, I actually look at all mortgages in a zip code where that zip code had an expanded boundary. So as you were saying, once a flood zone expands, banks may say those areas inside of a flood zone are risky, but maybe also those areas close to a flood zone or outside of a flood zone are also risky. And so I account for that more in the second part of my paper, where I'm looking what happens to that entire zip code. And I indeed do find evidence of spillovers, like you're saying, where LTVs are adjusting also for mortgages outside of flood zones. So what this means is that the first part of my paper, where I'm sort of doing this in versus out of a flood zone comparison, is maybe more of an underestimate of the true effect if lenders are also adjusting LTVs for borrowers outside of flood zones. So I guess the difficulty here, though, is that there's no sort of true flood risk measure. Like there's, Amine mentioned the First Street Foundation data, which I've used and which is great. And if you compare First Street to FEMA, there's about a 90% overlap in Florida, but in like Texas, it's about a 60% overlap. So it's much less accurate. So basically, there's a lot more work I need to do, and that I'm thinking a lot about in terms of how to deal with the fact that these government maps might be inaccurate. And like you were saying, there's uninsurable damages outside of flood zones if people are not required to buy flood insurance.
All right, let's see. Do we have another question here? Yeah. Yeah, please.
I wonder whether your results also hold for GSE mortgages, and for the loans that would be sold to GSEs or sold to FHA, what's lenders' incentive to pricing flood risk?
That's right. So that I didn't show this figure, but happily Amine showed it in his slides. There's this figure in my paper, figure 3, where I show that there's actually no significant LTV reductions for mortgages that are sold off. So either to FHA, if they're guaranteed, that are sold off or guaranteed. So the results are really driven by mortgages that are held on balance sheet, either because they're jumbo or because they're conforming, but the banks have chosen to hold them on balance sheet. So as you said, there's this interaction between whether the mortgage is sort of backed in some way by flood insurance or whether it's backed by one of the mortgage giants. Yeah.
All right, thank you, Erica, for your question. Now, let me give the chance to the online audience here. Well, Sam Hughes has a question about jointly looking at your LTV result and your interest rate result. Well, actually, Sam doesn't have a mic at his desk, but let me rephrase his question. He's asking, well, are banks both pricing interest rates in their rate sheets for flood zones and rationing credit by requiring higher down payments?
Yeah, in some sense, yes, because I do see that that the average interest rate is also higher in flood zones, even though the result is not statistically significant. That tells us that for at least some portion of borrowers, interest rates, two people with the same income, property value, and credit score will have to pay a higher interest rate. But I don't see that that's true sort of in general. It's a noisy estimate. And so what that tells me is that much more of the way banks are dealing with this is by requiring higher down payments, and the rationing is sort of more important than the price adjustment. But that's not to say that there is no price adjustment happening at all.
All right. Well, we do have a number of more questions on Zoom. And I think I also saw some hands here. Well, why don't we take the last question? Please.
Yeah, very interesting paper. I just had a question on this result that you had, that the remapping actually changed the selection of the borrowers to higher credit scores. So I'm just wondering if that takes us back to this identification question of, like wealthier borrowers have lower LTVs. So
Yes. So yes, absolutely. So the question is, if I may rephrase, how do I know that the channel is remapping to LTVs to borrower selection rather than remapping to borrower selection to LTVs? And basically, the way I deal with this is I've thought about what stories could lead an expanding flood zone leading to a selection of richer people. And I could basically think of two stories. The first story is that after remapping, the only people that are willing to live in flood zones are sort of less risk-averse people. And then less risk-averse people also choose to pay higher down payments. They want more exposure to their home. The second story is that the only people willing to live in a Florida flood zone are people who sort of don't believe in climate change. So there's this belief story. And I have this, not in the current version, but in the next version, I'll have this. I show that it's not likely to be driven by the risk aversion story because I show that deductible choices for flood insurance contracts actually don't change. So you would expect that if people are less risk averse, that they would actually take on a higher deductible after moving into a high risk area. And indeed, I don't find that. In terms of the belief story is harder to get at, but the way I try to estimate that is I look at donations to the Republican Party and at the zip code level, and I actually don't see any changes in donations. So there's a bit more I think I could do on the belief side. Sorry. But yeah.
All right, this is a great discussion. We're running out of time, so we'll move on. For those of you who submitted questions online, my apologies. All right, thanks, Perry, and thanks everyone. All right, our second presenter this morning is Ahyan Panjwani from Yale. Please.
Thank you. Thank you, everyone, for having me. I'll again be presenting my job market paper. So it's job market session this morning. So with that said, the rising threat of climate change is causing homes in certain areas to become stranded in that households now own an asset that is increasingly vulnerable to this unique threat, climate change. And the question I ask in this paper is, how do certain federal policies, which I'll just highlight in a second, how do these federal policies encourage home ownership in these highly exposed areas? And the two policies that I have in mind, the first is, and this was discussed just at length, mortgage rates, despite large variation in climate change risk across space, mortgage rates do not vary or take into account location-specific climate risk, that's flood risk, so on. Discuss this at length. I don't think I need to go into that. And on the other hand, households expect and indeed receive government assistance following a large climate event, which goes to a question that came up, so I hope to answer that one. The government spends billions of dollars following a large flood event like Katrina, Sandy, which I will focus on, and so on, Harvey got mentioned. And that, again, encourages homeowners to then remain in these highly vulnerable areas. And so to answer this question, I build a life cycle model of consumption, housing, and mortgage choice. And I show the importance of wealth and creditworthiness as drivers for sorting across space and housing sectors. Who chooses to own a home and where do they choose to own a home, in a high-risk area or not? To gauge the full extent of the incentives due to these government policies that I highlighted, I exploit Hurricane Sandy's landfall in New Jersey, and I show that government policies indeed encourage homeowners to remain in these risky areas, encourage entrenchment. And then I combine this quasi-experimental evidence with the life cycle model and show that these policies have particularly exposed poor but creditworthy households to climate risk over time. And the last piece is showing that a mandatory flood insurance, like the kind being rolled out, more stricter implementation of flood insurance requirements through, say, risk rating 2.0, would price out these households from these areas, potentially gentrifying these neighborhoods. Yeah. Some of the work done in this area, people are present here, Nancy, Ben, Amine, etc. Not going to go into that. The big sort of conceptual contribution here is to identify the marginal households whose decision-making is influenced by these policies. Yes, the rich might choose to live by the Florida shoreline, but who's the marginal household who's being influenced by these policies? And so I'll briefly give you a tour of the model before going into the results. Every period, I guess I should stay here because of the mic. Every period, there is a cohort of newborns. They vary by their FICO score and their endowment. They enter the economy. So in blue, you have agents who are rich by both FICO and wealth. And in deep red, of course, you have agents who are poor on both dimensions. They can either choose to live in a safe area, a risky area, or they can go into rental housing. If they were to live in the safe region or the risky region, they can buy a house and become a homeowner in which case they have to borrow from a lender, and the lending is conditional on their FICO score. They can choose a mortgage contract that works for them. They can choose to remain in the risky region by just paying their mortgage or refinancing, or they can move to the safe region, or they can move to rental housing, or if they could default, they're forced into rental housing for at least one period, and their FICO score is reset to 500. Now, importantly, the lender offers the same mortgage contract conditional on FICO score to the safe region, for the safe region and risky region, right? So there's no additional charge on the mortgage. There's no extra G fee on the mortgage if an agent wants to live in the risky region in the baseline. One of the policy experiments is, what if the mortgage rate was higher if one were to live in the risky region? The household eventually dies. In the rental sector, the household can choose to remain in the rental sector or move into risky region. It cannot move directly to safe region. If it were able to, I just look at steady state, so the model eventually settles in, and this wouldn't really make that much of a difference because it can just transition this way. In dynamics, it does, but I only look at steady states. It's not an issue, but saves on computation time significantly. And lastly, if the agent were to become a homeowner in the safe region, they just remain there by paying their mortgage, refinancing, and eventually die. The rental housing sector is immune from climate risk, and in that sense, sort of nested within the safe region. So only living here exposes you to climate risk. So why would you choose to live here? Well, there's an amenity value, right? So either it's a high productivity area, or there's some amenity value. You can think of it either way. And so that motivates people to live here. Lastly, there's a construction sector that provides housing to the risky region and the safe region. And there's a landlord who provides rental housing. Perfectly elastically provides safe housing, but there's some inelasticity for the risky region. So how do I model climate risk? It's a simple 2-point Markov chain. You can either get flooded or not, and theta percent of the house is destroyed. So 20%, for example, of the home can get destroyed. Think of it as the basement getting flooded, and so you only get utility from the remaining 80% of the house that's left standing. Every period, only a fixed fraction of people get flooded. And so the risk is idiosyncratic. There's no aggregate risk, which makes life much easier. And this is the only source of uncertainty, as income is purely age deterministic. And that is to maintain the focus on climate risk. One could think that there might be labor market outcomes because of huge floods. That is future work. So just to give a sense of the lending contract, the mortgage contract, suppose a household has a FICO score of 800, then it goes to the lender who offers the household this mortgage contract. They could choose an LTV of 90, and they would be charged a mortgage rate of 3.8, say. And so this whole surface, gives you the menu of mortgage contracts then. And for households with lower FICO scores, mortgage contracts are generally more expensive. And so the way I introduce the first distortion is that regardless of the risky or safe housing, the surface, the menu of mortgage contracts is the same. In a counterfactual, this surface will be a level shift up, higher mortgage rates at all points for the risky region, right? And I'll discuss how that shift up is, what the magnitude of it is. And the second distortion, which is that households expect and receive government assistance if they're flooded, well, that's just here in the budget constraint that I'll focus on. I won't bore you with the whole value function. In the budget constraint, there's a conditional government cash transfer. So I think of it as a pure cash transfer. If the household is flooded, it receives tau dollars. And the problem that I'll face is tau is the government helping with, fixing your roof with your pipes, but also mortgage forbearance, right? So that is a potential non-cash transfer that's being made, and it's hard to quantify what the dollar value of that is, because that's playing around with the option value of the mortgage. And so I'll try to put a number to this amount, and we'll discuss that in a minute or so. So, in fact, let's just get to it. How large are these distortions that the government has introduced? So, as I discussed, government assistance following a disaster is loans through SBA, through FEMA, so on and so forth. But importantly, mortgage forbearance, right? We discussed this at length yesterday as well. And so I use Hurricane Sandy's landfall in Jersey in 2012 as a natural experiment. And the question is, how did assistance affect flooded homeowners' housing decisions? And I find that homeowners are more likely to remain in their existing homes following a flood event where they receive this government assistance, including mortgage forbearance. And the question is, how large is that forbearance? I need to put in a number there for the tau parameter. And so I use a difference in difference setup. And my identification strategy is that, my identification assumption, is that conditional on flood risk, the parallel trends assumption holds. Okay? And so I'll show you the results and we can have a discussion during the Q&A. The blue points here is mortgage outcome, whether a household is current on their mortgage or not, between flooded and non-flooded, eventually what will be flooded and non-flooded zip codes, right? So the confidence interval covers 0, suggesting that the parallel trends assumption holds, okay? Meaning that before Sandy hits, which is at time 0, homeowners in flooded and non-flooded, which will eventually be flooded and non-flooded zip codes, they're equally likely to stay current on their mortgage. Not much of a difference. Then Sandy comes in at time 0, and homeowners start to become delinquent. They're not current on their mortgage. Why? Sandy hits at the end of October. Mortgage payments are due early first week of November. Homeowners can't keep up on it. All the assistance programs haven't kicked in yet. It takes a few days for the president to sign the declaration and everything. So there's this sort of pure negative shock there. But then as FEMA assistance and mortgage forbearance and all of that makes its way through, homeowners in flooded zip codes, and these zip codes are receiving assistance, they are much more likely to remain current on their mortgage relative to zip codes that were not flooded and did not receive assistance. So the comparison is flooded zip codes and receiving assistance, okay? It's at the 5-digit zip code level, so I have to make this assumption that flooded zip codes received government assistance. Yeah. All right. So, and then on the other side, the question is, how large is the mispricing in mortgages to start with? What we saw was the ex post after the flooding event happens, right? What about before? Because flood risk is not being priced into mortgages. I do a back of the envelope calculation and find that this flood risk premium not priced into mortgages is about 26 basis points on average in New Jersey in 28. Now, again, this is not the hill I want to die on, but this number is, in some sense, is intuitively it's similar to the 50 basis points number that was shown around. The uninsured losses that the lender might have to pick up, right? So this is the mispricing. So not that far off from the other estimate that was put out. How much does this number come out to be? Over 6 years, so between 2010 and 2015 inclusive, it's about $1.5 billion just in Jersey alone, okay? And Jersey is not the biggest state. It's not Texas. It's not New York. It's not Florida. So it's a pretty sizable subsidy being given out through this mortgage channel every period, every time a mortgage gets originated. So just a brief survey of the calibration strategy here. I will target government assistance, that TAO, government money given to a household if it is flooded and chooses to remain in the same home, to target the empirical value. So empirically, from that definitive chart, I find that flooded homeowners who receive government assistance are 74 basis points more likely to remain current on their mortgage relative to homeowners who were not flooded and did not receive government assistance. I then target this moment by picking the tau, how much does the government have to give to each household such that it would hit this number. So in the calibrated model, it's $48,000 on average. So the government gives an affected household on average $48,000. Some of this one can think is the SBA loan and grants and all of that, plus forbearance. Okay? So this includes forbearance amount as well, this non-pecuniary amount forbearance. This is included in this basket. It's the whole basket of help going to a household. Okay? And in the model, flooded homeowners receiving $48,000 are 62 basis points likely to remain current. Okay? And we can see how, given this calibration model, what happens. How do these homeowners split or sort across space? So I find that poorer homeowners, unsurprisingly, move to rental housing here. Fair enough. Homeowners with wealth tend to move to risky region and the safe region because they're becoming homeowners here. They don't want rental housing. There's utility from just being a homeowner. That's the American dream, to have a 30-year fixed rate mortgage. And some choose to live in the risky region. In fact, richer agents generally live in the risky region because there's a premium, there's an amenity value or a productivity premium. But there is a sliver, this pink salmon color, a sliver of poorer homeowners who end up in the risky region as well. Now, this is what's keeping our policymaker up at night. What can we do for this sliver of poorer homeowners who've ended up in the risky region exposed to climate risk? The rich, there's a really cool JFE paper, Let the Rich Get Flooded, right? Like, so be it. But what about these people, right? So what can we do? 2 policy experiments to wrap up this. First is suppose that the government somehow credibly commits to no assistance ex post. The government comes in and says, we will not bail out households, and somehow convinces households that this will be the case, right? I have a model, we can make this assumption, sure. And secondly, suppose that the government introduces location-specific, region-specific mortgage rates. Yeah? In fact, suppose that the difference between mortgage rates between the risky and the safe region is exactly the flood risk premium we found, 26 basis points. Okay? Meaning mortgage rates for risky areas go up by 26 basis points. Again, a bit of a challenge to actually do it, but I have a model, so you can still do it. Don't have to go through the politics of it. The outcome of interest is households' exposure to climate risk. Okay. I find that if these 2 policy changes were made, then about 73,000 fewer households would have been exposed to Hurricane Sandy. That's about 20% fewer households within Jersey exposed to Sandy. About $3 billion in savings because the government wouldn't have to bail out these households. There's muted price decline. The price decline is muted because I'm looking at a steady state world where the supply of housing has adjusted. I agree that if we were to look at the transition, the price decline would be much larger because there's a huge housing stock sitting there. Here, the supply of housing can adjust, and so the price effect is muted. Importantly, who are these households who are choosing to not live in the risky region anymore? These are households with an annual non-durable consumption of about $41,000 and liquid wealth of only $26,000, but a fairly good FICO score of 686, right? So these households are qualifying for agency mortgages, but they're fairly poor, so they choose to move they choose to live in the safe region instead of the risky area. Okay? However, the government might not be able to actually commit credibly, at least, to not bailing out households exposed, right? There's a political game, moral, however you want to think about that. So suppose instead that the government says, okay, fine, if something were to happen, we'll bail you out, but ex ante, we'll just levy a tax if you're living in the risky area. One can think of it as insurance, effectively, imperfect insurance. But suppose they levy a tax, okay, but also promise to the bailout. But they're able to still introduce the region-specific mortgage rates, right? So charging higher mortgage rates to higher mortgage rates to risky areas. So let's look at what happens here. If this were the case, then about 17% reduction in the number of households exposed to Hurricane Sandy, okay? And you get about $2.3 billion in savings. So 30% reduction in how much money the government spent ex post. Who are these households? They're poorer households. They're poorer households. Their annual consumption is about $27,000, and they have a worse FICO score, 644, right? So what's going on here? These are households who are poorer, and they barely qualify for an agency mortgage at this point. They realize that, well, the government will bail us out eventually, but we do have to pay this tax again and again, right? And so they would have wanted to live in the risky area because they know they'll be bailed out, and if they're bailed out, they don't have to default on their mortgage. They wouldn't lose their FICO score, which is what it is. But importantly, they're poor, so they're not able to post the down payment and buy into the risky housing market. So they're being priced out, right? So enforcing this kind of an quasi-insurance policy through a tax mechanism, making sure everyone's paying it, it's going to price out poorer homeowners. They would have wanted to live there. They won't be able to. They're being priced out, unlike the previous situation, which I want to emphasize, where the concern was, these high FICO scores agents wanted to live elsewhere. Why? Because in this case, these households, they're poor. They realize that if we were to live in the risky area and get flooded, the government doesn't bail us out, we might default, lose our FICO score, making housing in the future a lot more expensive, right? Or maybe prohibitive. So depending on how the policy is implemented, you might see that the number of households exposed is pretty much the same, 16%, 20%. But the composition, the marginal household who's being exposed to flood risk, that changes based on how we structured this policy. And that's extremely important. And so to conclude then, these federal policies have exposed poor but creditworthy households to climate change. These policies have distorted housing markets over time. Again, this has happened not in the past 5 years, 10 years, 15 years. FEMA and the National Flood Insurance Program is in the 60s, Fannie is in the 30s. So over decades, this thing has built up, and it has exposed Fannie and Freddie to climate risk, as has been discussed at length. And the risk rating 2.0 mechanism, the FHFA scorecard, will primarily impact these households who will be priced out of these regions, right? So thank you so much.
All right. Thank you, Ahyan.
Thank you.
All right. Yeah, our discussant is the Delinquencies from Wharton.
To kick off the day of great papers. So, I think the summary that was just given on the paper was excellent. It's very much a labor of love to get a model like that one to solve. A ton of moving parts associated with the model. And so what that means is that I'm going to be kind of poking at the calibration of the model and poking at some of the assumptions with the acknowledgement that it's often very difficult to extend or to make the model even more complicated, given how complex it already is. And the project is motivated by this idea that is well known. And I think the key here is to try to quantify the ways in which government policies encourage home ownership in risky areas. And so first, we know that Fannie and Freddie don't price regional risk, and I'm in the et al. Of the et al. There. So this is something I've been thinking about for quite some time. And the government rebuilds with large cash infusions after major disasters. And so FEMA and HUD spent about $6 billion after Hurricane Sandy. There are other loan programs that are floating around in here as well. And we have to include this GSE forbearance as an important element. I think one of the tensions that we face in researching this question is we say, well, this is really bad for the mortgage market. And then we go and we look at the mortgage data and it always looks fine. It's like, well, no one defaulted. It's, well, yeah, there were huge forbearance programs and all this other assistance. And so we need to try to tease apart those other sources of assistance and start to question, well, what if that assistance isn't permanent, right? What if the non-coastal parts of the country rise up at some point and say, we're sick of subsidizing coastal development. One element that's kind of missing from the list in the paper is NFIP and thinking more systematically about flood insurance. And so it sort of came up in the slides in a couple of places, but it's just a missing element of the paper throughout, and thinking about how to integrate it into the model and how to think about the calibration. That $48,000 of a transfer is in part flood insurance. We also know that flood insurance take-up is woefully incomplete. And even those households that are quote unquote mandated to have it in many cases don't have it. So a recent audit suggested that 16% of those who are technically required to have flood insurance don't. And that's actually a low estimate relative to what's been found in the past. And to sort of the two comments from the two papers this morning, that many outside the high-risk floodplain are the ones most harmed by some of these disasters as well. So there are ongoing consequences of having this type of policy, and this is just a table from Climate Central. This is not an old problem. Houses are actively being built in the flood zones right now, and the biggest offender is actually New Jersey over the 2010s. They built, and this is largely because of rebuilding in the wake of Hurricane Sandy. We're going to build back better, right? Such misguided policy here. $8 billion of new builds in Jersey and Florida alone over this time period. So development is ongoing in these areas. And so what's great about this paper is it takes a very sophisticated look at the effects of these distortions on coastal housing markets. And you saw the schematic of the model. There's homeowners in two different locations. There's renters, there's landlords, there's developers, there's lenders. The life cycle model here has a lot of moving parts. And then after the model is calibrated, based on some estimates from Hurricane Sandy, he's going to look at two policy changes where mortgages are now going to finally price regional risk, and where the government can commit to not bailing out households ex post, and then also a version where there's a sort of a lump sum tax for living in the risky area. The findings are that the policymaker, if they can make these changes, which again politically are quite challenging, the number of homes affected would fall by 20%. And even if the government can't commit to bailing out, you can just tax those ex-ante risky residents, and that reduces losses by 30%. So my takeaway from the paper was, wow, these seem like really effective options. We can just price the risk a little bit, and that's going to really deter development and residing in flood zones. And my concern and sort of the theme of my comments is, well, maybe the model is too effective. It seems like people are maybe a little bit too responsive, too elastic to some of the costs that they're facing here. So the first comment I want to talk about is flood insurance. So the model doesn't include flood insurance right now. And that means that there's no ex-ante way to protect yourself from risk except just moving out of the area. And homeowners are doing all their repairs out of pocket. It means that there's also none of the issues with an insurance market, right? So there's no asymmetric information. There's no moral hazard. There's no incomplete take-up. But I think one of the challenges here is just thinking about what role would introducing an insurance market play? Would that make households more responsive or less responsive, right? A lot of the households that are currently living in flood zones are saying, yes, I'm in a flood zone and I'm also insured against that risk, and I may be subsidized in terms of the benefit of that insurance. So, I think one of the issues here is, the second sort of policy exercise is to make something that looks like flood insurance more universal or more mandatory, but it doesn't take into account that a lot of households are already making those payments. So I think just discussing flood insurance more rigorously, thinking about how flood insurance would fit into the model, and then making very clear that that 48K of transfers includes the NFIP subsidies would be a great place to start. And then one of the other margins of elasticity here is the rental market. And in this market, in the model, renters are assumed to be immune from disaster shocks. And we know that's not the case. There are lots of renters that live in coastal areas. We know that they're harmed by disasters, and there are lots of news stories. This is sort of a chart that's drawn from from an NPR story that's drawing on some research by a team of sociologists showing that, ex post a disaster, in many ways, renters look like they've, for whatever reason, had the biggest harms. And that might be because of the disruptions to their personal networks, to the labor markets, and so on. And so if we think that part of the story here is about sorting and there's kind of a climate gentrification angle, we need to think in a much more sophisticated way about the choices that renters can make. And then I want to just poke a little bit at the calibration of the model here. Again, a ton of moving parts, but there were a couple of takeaways from the model that kind of raised my eyebrows. So one was the price premium for living in the safe area versus the risky area. And so that's the line here I've highlighted in red. The empirical target is that there's a 4% price premium for living near the coast, kind of all else equal. And in the model, it's 24%. And those two things seemed quite different to me. So that's like a six-fold difference in the premium that households are willing to pay to live near the coast in spite of the risks. And it feels like, okay, well, does this mean that coastal utility, there's something about coastal utility that's too high? Are homeowners just not sufficiently risk averse? Is this another case where if they're paying for insurance, we could understand a little bit more about their willingness to bear the costs of that insurance? So is this just another issue with kind of omitting flood insurance from the model? But it seems like there are a lot more people who really want to live near the coast in the model versus in reality. So it doesn't seem like it's fully capturing some of those costs or recognition of those risks that are already in place. And then when we look at the untargeted moments, so these are sort of like the outcomes of the model, we find a big difference in prepayment rates, and we see a sign flip in the likelihood of defaulting ex post. So again, this is kind of trying to incorporate all of the different ways in which coastal living is subsidized, in the ways in which the bailouts occur. But seeing this sort of much higher prepayment rate in the calibrated model, I wanted to see much more discussion of why there were bigger differences. And just anytime you see in a calibrated model a sign flip, you start to worry that there's some other underlying factor that's just hard to tease out that might be driving things. So the model is calibrated on the basis of a quasi-experiment around Hurricane Sandy. And it's a difference in differences design where he's looking at zip codes that are exposed to Hurricane Sandy and those that were not, and looking at mortgage outcomes thereafter. And I thought it was an unusual choice to use the version of the specification that didn't have the controls for things like FICO score and LTV. And we saw from Pari's talk earlier just how much that attenuated some of the effects, that the controls were really important and that geographic controls mattered a lot as well. And it looks like from what's available in the appendix that it's hard to tell exactly what controls are included, but the coefficients fall by maybe a quarter to a third. And that could really swing some of those estimates of that $48,000 in particular, which sounds to my ear like a big number, like households are getting this enormous transfer ex post. Well, here's one way to bring that down is to include some controls. And I just think, more generally, when we're thinking about running mortgage regressions, it's really important to control for that FICO by LTV grid that was put up earlier. And just so many compositional differences across regions. So I think if the goal here is to make an apples to apples comparison, we really want to see things with like county fixed effects and compare two zip codes that maybe were differentially affected, kind of zooming in maybe on different regions of the state if county is too restrictive, and then trying to get similar households in terms of FICO and LTV and look at their prepayment and default outcomes. And then finally, the house price numbers were interesting as well. And just thinking about how households are responding to this change in policy. So we have one government policy where we raise interest rates by about 26 bips. And then we have a policy where we impose a $560 tax per homeowner. So that's about a $1,200 a year burden for the average household. And in the model, that would shift about 17% of homeowners out of the risky region of those who are harmed. So that seems that homeowners are very elastic about this choice. And so I was having trouble thinking through that effect size and thinking about some of the frictions that might be there. And again, thinking about how these are capitalized into house prices. And so thinking through not just the sort of small dollar transition to house prices, but also the long-term dollar difference, which I think is a really interesting takeaway if you can push the model a little bit further to go in that direction. So I'll wrap up there. I think, again, this model represents a really high achievement in terms of solving a very complicated system here where households have a number of different decisions and have spatial choice. And I think the model does capture a lot of realistic aspects of how climate risk is influencing household choices. And so I'm excited to see the work progress as it sort of fits more tightly with some of the real world policies around insurance and some of the choices that renters and others have to make. Thanks so much.
All right, thank you so much, Ben, for the discussion. Let me invite Ahyan back to the podium, and let's get to the Q&A session. Well, yeah, I forgot to do this, so maybe I should give you like 30 seconds or a minute. You want to respond to any of the comments?
Sure, why not? Should have made some notes. I guess I can look that up. Right. So one comment was on including FICO and LTV, which agreed. And clustering standard errors as well. I think that was on the slides. I do have it in the robustness parts of it, and indeed that would change the $48,000 magnitude, of course. Yeah, and so you can work around that. On the untargeted moments, the sign did flip for defaults, but it's close to zero. It's like -12 and 2. So sign does flip on one of them, and it's concerning to some degree. It's actually, the reason is the cost, whether it's pecuniary or non-pecuniary cost of defaulting. Also sort of when we think about prepayment, it's this attentiveness or alertness, and I don't have that in the model yet, so that's why like this sort of bang going on. And then the other thing that makes it on the targeted moments, the reason for that 24 versus 4%, and likewise there's the ratio of people living in one region to the other, there's some significant discrepancy there. The reason for that actually is that there's a one size house, and homeowners have some preference for living in the risky region and non-risky region. So there's this discontinuity baked into that, which causes homeowners to shift, a significant mass of homeowners to shift from risky to non-risky areas, right? So that causes that almost bang type thing. I've tried to work around that, but again, that model, because you already have the kinks in the value function, and then the affinity for amenity versus safe region, that introduces another kink in the value function. So that's the artifact of that, is the discrepancy in the targeted moments. Yeah.
All right, yeah, Lauren just reminded me that we only have like 3 minutes left. So maybe let's take 1 or 2 questions from the audience. Igor?
Yeah.
Thanks. I think I'm just a little confused. Mm-hmm. You were showing that the default rate in flooded region is actually lower after the flood.
Yeah.
And yet you're talking about mortgage subsidy and mortgage being not expensive enough in those areas. Why should mortgage be more expensive when the default rate is lower?
So the reason the default rate or the delinquency rate is lower is because there's forbearance, right? So ex ante, Fannie wasn't charging for that benefit. particularly through this flood risk channel. But once neighborhoods are flooded, the government comes in and tells Fannie, hey, you got to put these homeowners in forbearance. And so we see it's, I think Beth mentioned it's like all good ex post, but there's a cost to it which wasn't included ex ante, right? So yeah.
All right, anyone else? Let's see. Okay. All right. Looks like people are very satisfied by
That's always good.
your presentation as
Maybe
well
you
as
live in
Ben's
uninteresting
discussion,
times.
right?